The real question is not whether confidence is dropping, it is why it is happening now, and what it could mean for your money in the months ahead. Consumer confidence is essentially a measure of how optimistic or pessimistic people feel about their income, job security, and spending power. When confidence is high, people spend freely. For many Americans, wages have not increased fast enough to fully offset these higher costs. As a result, people feel like they are working just as hard or harder, but falling behind financially. Uncertainty alone can be enough to weaken confidence. Even before actual economic damage appears, interest rates are another critical factor. Higher rates make borrowing more expensive, affecting everything from mortgages to credit cards and auto loans. For households carrying debt, monthly payments consume a larger portion of income, leaving less room for discretionary spending. This pressure builds slowly, but once people feel squeezed, confidence drops quickly. So why does consumer confidence matter so much? Because consumer spending drives nearly 70% of the US economy. When people pull back, businesses see lower sales, profits decline, and investment slows. That can lead to more layoffs, reduced wages, and even lower confidence, creating a self-reinforcing cycle. This is how economic slowdowns often begin, not with a sudden crash, but with gradual shifts in behavior. Financial markets pay close attention to these trends. Falling consumer confidence can weigh on stock prices, especially for companies that rely heavily on consumer spending, such as retail, travel, and discretionary goods. Investors may become more cautious, rotating into defensive sectors or holding more cash. Volatility tends to increase when confidence weakens, as markets struggle to price in future growth. For everyday Americans, the impact is more personal. Slower spending can mean fewer job opportunities, smaller raises, and tighter financial conditions. It can also influence major life decisions, whether to buy a home, change careers, or make large investments. Even those with stable finances often become more conservative when confidence declines, simply because uncertainty feels risky. However, falling consumer confidence does not automatically guarantee a recession. It does signal stress, caution, and rising uncertainty. Policymakers, businesses, and investors watch these indicators closely because they often change direction before the broader economy does. Confidence can recover if inflation eases further, wages rise, or job security improves. But until that happens, cautious behavior is likely to continue. For individuals, this is a time to stay informed and financially disciplined. Understanding why confidence is falling helps you avoid emotional decisions driven by fear. It's also a reminder to focus on fundamentals, managing debt, building emergency savings, and making long-term financial choices rather than reacting to short-term noise.